Hi there, Mariette Martinez here, and I want to talk to you about tracking your money in and money out. It's an essential step in building out your tax ready books. So let's talk tracking. All tracking really is just bookkeeping. And so when we talk about bookkeeping or when we use accounting or when we use some other type of, financial literacy language, it's all essentially the same thing. I need to track my transactions in some kind of bookkeeping system. Again, if you've been in business long enough, as I have been, and especially since I worked with my mom in the restaurants, her books were literally books, like ledgers, big ledgers that we would have to write down the money in, the money out. So we were able to really see and have a financial visibility on, okay, well, are we going to have enough money to pay payroll? Are we going to have enough money to go back and get some more meat or get some more supplies for the business? And so we needed that financial visibility. And so the tracking was incredibly critical to be able to make more confident decisions in the business. Also, when you start tracking or bookkeeping for that matter, when you start the bookkeeping for a business, you also start saying, hey, okay, well, now that I'm tracking everything, I want to try to have the highest tax savings possible. So then what you start doing is you start combining your bookkeeping with your tax strategies. And so you start thinking, okay, well then if I am going to have to spend on my business to build my business and to grow my business, it makes perfect sense that I'm going to be spending on qualified expenses, which hopefully will eventually be tax deductible. Now, where is all this stuff going to be stored? That's the other big question. The tracking is also a bookkeeping system. And so what is that bookkeeping system? Where is everything going to be tracked and saved? And that's what I like to call the source of truth. So where are you going to save everything so you actually can sleep at night and know that if something happens or if an organization knocks on your door, you're going to be ready for that. Another reason that you want to track your expenses is because, again, you really want to focus on what's considered ordinary and necessary for your line of business. So that way you can be able to qualify for the Internal Revenue Code, which requires for your business expenses to be ordinary and necessary for you to possibly deduct them. So what is ordinary and necessary? That's really important. Well, interesting enough, it's a very simple definition. Ordinary is one that is common and accepted in your trade or business. Necessary is one that is helpful and appropriate for your trade or business. So if you look at that, that actually gives you a very open-ended opportunity for you to use necessary expenses and ordinary expenses for your industry, for your line of business, for your business profile, for you to grow and thrive as an entrepreneur. IRS, Internal Revenue Code, is just telling you that it needs to be ordinary and necessary for your business. But that is a great opportunity for you to really research what makes sense for your type of business. Okay, so now that you understand the importance that tracking is just really bookkeeping, and that if you are doing all this work to track all of this information, that you should be thinking about what's considered qualified business deduction, so that way you can possibly use that to be more strategic with your taxes and with your planning. So now let's take those concepts into tracking the money in and also tracking your money out. So let's cover tracking money in, because there are so many types of monies that can come into your business. So let's look at this from the perspective of first keeping track of your gross income. So what is gross income? Gross income is non-employee compensation for services rendered, including payments received in cash, check, cash app, or credit cards. Now, why do I say non-employee compensation for services rendered? The reason why I'm very specific is because the self-employed individual, most commonly when they first started, they're contractors. And when they're contractors, unfortunately, they're in a very tricky situation, because if they don't have any of this information, if they have no financial literacy education or background, they don't know what it means to be a contractor versus an employee. And so many times when they start working with, let's say, 2, 3, 4 different clients, let's say truckers would be a perfect example of that, or Uber drivers or Lyft drivers. So they start working for Uber, or they start getting paid through Upwork, or they are working as a trucker for 4 big companies, they think that those big companies are their employers. And absolutely, they are not their employees if they're getting paid gross income. They would only be their employees if they were actually on payroll. So what is it that they are receiving? They may be receiving a 1099 miscellaneous. They may be receiving a 1099K. They will be receiving gross sales from a client if they're working directly from a client and they invoice that client, right? They may be receiving commissions. So we're thinking about those real estate agents or those sales agents that get a commission check at the end of the month, and it's a gross check. Those individuals that receive cash payments are getting paid in cash, maybe through the Cash App or tips. That's all gross income. If you sell something and have a gain on it, that's also gross income. And bartering. So if you go and you barter with your fellow service provider, that's also considered income. Okay, so where else can you obtain income for your business? Now, these are areas that you all should be aware of, because whether or not you're waiting for a form, so again, you may not be receiving that 1099 miscellaneous, you may not be receiving that 1099K, but you know where all your money's at. Your money's on your bank statement. The money is clearly going into your bank account and should be clearly seen through your deposits. Also, many times you may be using a point of sale system. So for instance, many of my clients that were in the wellness or the health and wellness community, my barber shops, my beauticians, they would use a point of sale. And so they would actually see those gross sales on those summary reports. And that was really important because they would be able to match those reports eventually with the monies that got deposited into their bank. So if they were like, hey, Mariette, it looked like this week I grossed, $15,000, but why do I only have $13,000 in my bank? So what we would do is we'd actually do a reconciliation between their point of sale system and their bank. And we would realize that maybe the point of sale system isn't taking into account that they're getting paid with credit cards, and the credit card companies are reducing their funds by merchant fees. Do you see how important now it is to be able to see where those information is coming from, so you can start doing reconciliations and you can start finding and troubleshooting those areas? So those are the kind of things you all want to be thinking about and looking for. Of course, you could have a cash receipt book. Any contractors that actually work on the job all day long, they still use the receipt book. They give me a receipt at the end of the job, and then they have to go back now and reconcile that into their electronic system. And you also may be writing this all down in some type of spreadsheet ledger as well. Now, what other money transactions should you be thinking about? Now, these are the ones that are more interesting because, when people think about money in, the first thing they think about is income. So there are other types of money in transactions that come into our bank and have to be posted into our books, but they may not be revenue. And these are examples of them. For instance, when you deposit your own money into the business, that's considered an owner's contribution. If you get a loan from a bank or you have lines of credit, those are actually considered liabilities, but of course they do inject cash into your business. Maybe you have some cash advances or grants, or maybe you bought something from a vendor and you didn't like it, and so they refunded you. That's not income. That's a refund from an expense that you paid out to a vendor. And so those are the type of transactions now you want to start thinking about, because again, our brain commonly goes to, oh yeah, all deposits are income and all money out are expenses, but not necessarily. So now we're going to go ahead and cover tracking the money out. So this is what I want to cover as the lowdown of what expenses to be tracking. Now, again, when we talk about money out, there is the legitimate expenses or ordinary and necessary business expenses that are very common as a business owner. And then we'll also cover some additional not so ordinary business expenses. And then we'll also cover money out that may not even be considered an expense. So let's start with the lowdown on what are common, ordinary, and necessary business expenses. On the Schedule C Part 2, the IRS essentially gives you your list of expenses. And so many times when I speak with a self-employed business owner, they go, well, what expenses can I deduct? And I always ask them, have you ever looked at your tax return? And so I always usually tell them, well, let's go ahead and do a little practice here, a little game. And I want you to go ahead and actually open up the Schedule C. It's super simple. Just go to Form 1040, Schedule C, Google it. And when you go to that Form 1040 Schedule C, look at all of the different expenses that are available to you. It's that simple. And then you can start thinking about your own business profile. Again, when I talk about business profile, what line of business are you in? What's common for your business? What's ordinary and necessary for your business? And then start thinking and writing those down. And that's a common practice that I do with my self-employed community. And so again, these items here should look pretty similar to maybe things that you're already taking in your business. Ones that I just want to highlight, with the Tax Cuts and Jobs Act, there's no more entertainment that's able to be deductible. So you can, of course, use it as a business expense, but you won't be able to deduct it. Business expenses that are limited, for instance, meals. When you have a meal, or when you take your client out for a meal, or when you're traveling and need to eat on your travel and have a meal, those are 50% deductible. And so not only do you want to keep in mind that there are specific expenses related to your business, you also want to make sure that you know that there are some exceptions sometimes or limitations to those expenses. So again, the most common thing to do, or the smartest way for you to get a jump start on this, is go grab that Schedule C Part 2 and see what's available to you on that form. Now let's actually cover some not so ordinary business expenses. Now, when I say not so ordinary business expenses, what I mean is that many times when business owners think about their expenses, they think about two things. First, they think rationally, okay, well, I need this for my business. It's ordinary and necessary, so it should be an expense that I can deduct in my business. And then the next thing they may do is they may go ahead and grab that Schedule C and look what's on that Schedule C under expenses. What they may miss, though, is that there are some business expenses available to this business owner that they can also take as an expense on their business. That's why I like to call them not so ordinary, because it's not that common expense you would think about, and it possibly is also an expense that you will clearly see on your Schedule C. So here is a list of those expenses here, and just something to note here is that these expenses may require additional substantiation. They may require more complex calculations, and they're found in a different place on a tax return. Many times they are. Let's say you want to go ahead and take mileage. Well, that's going to be found in your mileage log or on your mileage app on your phone. And you're going to want to go ahead and export that into Excel and create a mileage log, and then take that expense to create your tax-ready books. What about the transactions that are related to you actually paying a business expense with your personal fund? What's important here is that if you legitimately paid a business expense with your personal funds, then you're essentially needing to create a petty cash log so you can explain, hey, I have these 5 receipts that equal $500, and I want to go ahead and expense that back onto my books. How do I do that? And so then you're going to go ahead and have to post that back into your book so you can have tax-ready books. But you need to be keeping track of that, because that is a not so ordinary expense. Now, let's close this conversation with the not so ordinary and many times not even expenses transactions, but they are still considered money out transactions. Number one, this is the most common one. What happens when I pull money out of my self-employed business? So when you pull money out of your business, that is not considered an expense. That's an owner draw out of your equity, out of your profit. And so yes, can it be money out? Absolutely. Is it money out? Yes, it is. But is it an expense? It is absolutely not an expense. Also, what about if you did get that loan, whether it was that private loan or whether it was that bank loan? What happens when you write those checks back to those loans? What part of that payment is an actual expense and what part of it is not? So you went ahead and you got a $20,000 loan. Now it's the next month, and now you have to start amortizing that loan and paying it over, let's say, 3 years. You write that first check for that loan. Is that an expense? Are you just writing an expense for loan payments and putting that right on your profit or loss? The bank loan is considered a liability. So a liability basically means you went ahead and injected cash into your business, and let's say it's that $20,000, and you need to pay that full $20,000 back. So when you start paying that check back, you're going to be paying that $20,000 back, but the bank's not going to just lend you $20,000. They're going to lend you $20,000 and then charge you for the cost of capital. And that cost of capital is called interest. And so when you are writing that check for the principal and the interest for that bank loan, the principal is actually just a repayment of that loan, which is not an expense. But the cost of capital, so the interest you have to pay because you got a $20,000 loan, that is considered an expense. So see how tricky that can be? So the principal payments back for the $20,000 loan is not an expense. It's just money getting paid back to the bank. But because they're charging you interest on borrowing money, that interest is actually considered the expense. And so what do you need to do there? You need to split that transaction. Now let's use the example of the credit card payment. So you go ahead and you charge, let's say $5,000, it's your first month, you are a field service provider and you buy a bunch of materials at Home Depot. When you first charged that $5,000, that was when you actually received the expense for those supplies. You swiped your credit card, and that credit card, those transactions possibly hit your credit card account. Now it's the end of the month, and let's say you're very disciplined and you're going to pay that full $5,000 payment back to the credit card. All you're doing is paying off the balance. You already got the expense for the credit card transactions when you first swiped that card. And so you can't call the credit card transactions when they hit your credit card an expense, and then a month later when you pay off your credit card, that's not another expense. That's just paying off the credit card balance. You see how that can get tricky, especially when it comes to thinking about it? Some other type of money out transactions are monies transferred from bank to bank. That can get very, very tricky. We know that if you transfer money from your savings to your checking, or your checking to your payroll, or your payroll to your savings, we know that that's not an expense at all. That's just money going from one hand to another. And so we know for sure, is it a money out transaction? Absolutely. Is it an expense transaction? Absolutely not. Also, returns to customers. So when your customer pays you and then you have to return the money back, that's not an expense, that's a return of the original payment. And then another money out transaction that's very common is that you may actually have a money transaction that you'll need to split between the business and the personal. Again, this is not something that we would ever suggest as an accounting or bookkeeping professional. We discourage any type of commingling, but I am well aware that when you're a self-employed individual, if let's say you go to Costco and you had to buy, supplies for your business, and then, oops, I decided to put some shampoo and conditioner into that checkout line. Well, of course, you're going to go ahead and put the shampoo and the conditioner as a personal withdrawal, but the business supplies, if you went and bought folders and if you bought pens and other supplies, you can absolutely call that a business transaction. But what would you have to do in that case? You're going to have to split that transaction. The last thing I want to cover when it comes to expenses and money out is also, let's go back and bring up that conversation about thinking about what you can deduct and how to be more strategic on your taxes. So there is nothing wrong with wanting to maximize your tax savings. So when people say, I want to save more taxes, that's an absolute legitimate strategy. We all should want to save more taxes. We're not saying we don't want to pay taxes, and we're definitely not saying we want to evade taxes, but we can think about our business from a perspective of what we do and how we manage our business and our finances. And when we think about that, what are the best ways or best choices to make to maximize those tax strategies? So for instance, if I know that I can work out of my house and have an outside office, is there a way for me to be able to deduct both the outside office and the home office? Let's say, for instance, I drive a lot for my business. I'm an independent contractor. I'm a field worker, a field service worker. Does it make sense for me to use my actual expenses for my car, or does it make sense for me to use a standard mileage? Let's say that I am in a business where I have to drive a lot of my clients around. Does it make more sense for me to buy a business vehicle? And if I need to do that, should I buy the vehicle outright or should I lease the vehicle? Does it make sense for me to actually invest in learning? Of course, you're all here, right? So you're investing in education. What other ways can you invest in your business? You can leverage technology. You can start building out your systems. Does it make sense for me to go ahead and create a more robust customer management system or start implementing new apps like QuickBooks Online or other type of smart apps for your business? Well, does it make sense? Ask yourself the question, is it ordinary and necessary for me to build, grow, thrive, and succeed financially in my business? If it is, then it could very possibly be a legitimate expense, which means you should be able to deduct it, which means you're maximizing your tax savings. And this is really just a bonus slide for you to really think about different areas of your business and how you can maximize those tax savings with your deductible business expenses.
And now that you know the essence of money in and money out and maximizing your tax savings, I want to say thanks for making it to the end of this video. So in the details, you will get a bonus checklist with the 8 startup questions to begin your tax strategy journey. Hope this was helpful and see you in the next video. Bye for now.